the Climb Finance Show. I'm your host, Kian Lynch, and thanks very much for joining us tonight. Tonight we are going to talk about gold and silver prices as investments. This is the 10th episode of the show. Please like this episode, subscribe, and share with any friends or colleagues that may be interested in this video. We're going to go through a quick review of gold and silver prices over the last few weeks, as well as a longer time frame. Then we're going to just take a look at the S&P 500 in comparison. Lastly, we're going to review a very interesting article from CNBC that talks about the causes of the recent price movements. And lastly, we'll take a look at the Federal Reserve's chances of increasing interest rates even further and the effects it would have on gold and silver and commodities in general. And lastly, we will make a determination if the average investor should be allocating a small, large, or 0% allocation of their portfolio to gold and silver. So as we take a look first at the gold chart here, we're taking a look currently at gold prices over the last 20 years. You can see that initially it started below around 250 range. Now we're at 2,000. So it's really quite the increase. If we do take more of a much, if we do a much smaller time frame here, we will see that on the monthly period that beginning of October, gold has seen a sharp increase from approximately 1840 up to 1970. A gain of almost 9% since October 3rd. Taking a look over here for silver, we are going to see something very similar with silver. Over the last 20 years, a low of about $4. Then it surged all the way up to about 44, currently sitting at 23. Take a look at the last month, and we see something incredibly similar with silver, essentially surging 9% since October 3rd. We're going to get into the factors behind that, but taking a look at the S&P 500 over the same time period, early October, it did see a solid surge, surprisingly, throughout the Israeli-Palestinian war, but it's seen a sharp decrease, or a relative decrease, since then. And so make no mistake about it, gold and silver are relatively surging over the last 2 weeks. The reason behind that majority being the Middle East tensions. As this article says, gold firms for third day on Mideast conflict, hopes of Fed rate pause. So gold gained for the third consecutive session on Thursday as growing tensions in the Middle East sparked safe haven demand, in addition to the remarks from Federal Reserve Chair Powell, fueling hopes the central bank may pause rate hikes. Essentially, as the war continues between Israel and Palestine, we could even watch Biden's current address on this if we wanted to, showing how important this is. Gold has been gaining due to the war as the safe haven commodity. When everything falls apart, gold sees an increased demand. However, this strategist says buying exhaustion is fairly imminent. Then you bring in the comments of Federal Chair Powell, basically saying not much, but the market interpreting it as Fed rate hikes most likely will not happen. You see here, traders now see a 70% chance of no rate hike in December compared to 50% prior to his comments. And lastly, the last thing here, a recession would allow the Fed to cut rates and help move gold prices north of 2,100. So all in all, combining the Middle East tensions with our Fed watch tool here showing interest rates, it seems that gold, quite frankly, looks very positive, as the Fed seems to be done raising rates, barring any change in economic indicators, and then adding, in addition, global war, and it presents a bullish scenario for both gold and silver. gold nearing some of the highest prices it has seen, silver has so much more room to run until it reaches its previous high of about 44. Some call this the opportunity of a lifetime with precious metals, and I'm not as bullish to say that, but my recommendation is a solid allocation to precious metals is warranted. Thank you very much for tuning in. I hope you enjoyed this episode. Have a great rest of your day. Klein Finance Show, Key and Lynch, we're out.